Hi, this is Robert Kiyosaki, and you're listening to Capital Hacking. This is the most important thing you can listen to today.
He's the one.
I have a dream.
With great power comes great responsibility.
I could do this all day.
This is it. Don't get scared now.
They may take our lives, but they'll never take our freedom.
Cinderella story out of nowhere.
It's in the hole. That the only thing we have to fear is fear itself.
Capital Hacking begins in 3, 2, 1.
Welcome back to The Big Show. Josh McCown here. Just want to say hi. I get to do this show today by myself. This intro is even by myself. I get to say hello to my best friend, John Edwin, and tell him I love him, but he's not here today. So he said, Josh, I bless you, my friend. You get out there and you do a great show. So in order to do that, I went out and found a great guy named Patrick Grimes. He had just hosted a really incredible national panel called Hospitality Investing, basically where we went over all the mechanics, and he grabbed some of the best operators, and we were there along with some others, and we dug in through his platform with his audience on the hospitality investing. And spoiler alert, we could not believe the feedback for the deals we're doing right now, which is incredible with that project called Capital H6. So if you're curious about what we talked about last night, please just hit us up at accountableequity.com and we will show you what we talked about last night, because it was a barn burner. Everybody was excited about it like we were. And that led us to a great relationship with Patrick. So let me tell you about this gentleman. Engineer by training, 25 years ago, started getting introduced to private investing. And today, after the good news here, he's had some setbacks like all the best people. He's also had some successes. And today he's built a platform of education called Passive Investing Mastery. And that does really interesting national platform webinars each month. And we were on that. So if you're excited to meet a Forbes author, a writer for Forbes, an Amazon book bestseller, a sponsor who knows about real estate, multifamily, other types of debt funds and credit funds, we have a show for you today. But here's the reason you're going to want to stick around. Well, that was great. He shares a deep analysis of the difference between REITs. If you haven't heard this topic yet, today you're going to get a deep dive. REITs stand for Real Estate Investment Trust. And he wrote a great article on Forbes called The Ruse of REITs. Now, that's a fancy word. You'll have to wait around to find out what that means. But check out this episode and let us know what you think. Enjoy. Well, Patrick, I am excited to get to know you better. I mean, it was fun being on your nationally syndicated show the other day and talking about hospitality investing, and you do a great job with those. So we're going to get into that. But for those of us who are listening today and who have not met you yet, sir, would you mind sharing your backstory and kind of business you're in today and what you're passionate about?
Yeah, was delighted to have you on our Mastery series, Josh. You did a great job on hospitality. It was incredible conversation. So thank you for that. So Patrick Grimes, I was just like probably many of your listeners, Josh, a hardworking professional, busting away in corporate America. I was doing automation and robotics. Loved it. Machine design. I'm still a geek today. I don't do as many geek things as I used to, but it's still there. And I just got into investing earlier, more so just because I talked to the founder of the company I was working for and had a lot of respect for him, still do to this day. And he's got a lot of investments with me now. But he encouraged me. He said, "Hey, don't go put your bonuses into more startups and stocks and crypto. Put them into real estate. Put them in alternatives." And that's how he actually developed his wealth. Made it in high tech and invested into real estate. And so that's what was kind of like my aha moment, and kind of that started the really bumpy and windy road from there.
And that was while you were an engineer, correct? And you said that was the owner of the company that you worked for? That's great. So basically you were getting mentorship at work there. Was he doing that kind of sharing about that kind of financial independence and financial literacy with others? Did you seek it out? How did that come about?
I don't think anybody else was ever present in any of our conversations. So I don't know if it extended to anybody else, but I was a talented engineer. I started doing R&D projects, which meant I started working closer with the two founders and started traveling out and working with, really cool medical devices, from diagnostic stuff. I mean, through my career, I've done heart valves, I've done, ablation catheters, I've done all kinds. I did a bunch of stuff during COVID. I've done solar cells for Lockheed missiles. I've done airlines. I've done Tesla's rotor assembly, robotic assembly. I did a lot of stuff. But I mean, I got to the point where I was kind of in a lot of contact, and I started getting some bonuses in, and I was like, wow, like, what do I do with these? And so was in that conversation, that he shared. His only regret was not investing more sooner into real estate.
Okay. So he's your mentor and he introduces you to commercial real estate. Does he recommend a sponsor? How did it go next? Like, how did you find your first sponsor to partner with and invest?
Okay, this is where the bumpy road happened, right? Because this was back down 2006 and 7, and 8. Like, real estate was never going to go down. It was basically free to buy stuff. And I was just a snot-nosed engineer wanting to rule the world. And so I got my head over my skis, purchased development, a lot in pre-development, speculative, high growth, double, triple my money every year kind of thing. I'd done some research on the last half dozen projects, but I hadn't zoomed out far enough to look at what happens when the market takes a turn and what is a recession resilient asset class or investment or region. I had no idea. 2008 and 9 hit. I was upside down very quickly. I flipped upside down, unfortunately. And I paid for years, was determined not to go bankrupt, but I ended up had to pay taxes on the forgiven debt in the subsequent year, which was kind of brutal. It's like the debt that the bank forgave became ordinary income for me. Yeah. So, I was battered and bruised, but it was lessons early. Fail early, they say, right? And, but it didn't make. I was still a talented engineer. I got a master's in engineering and an MBA and doubled down. And when I finally got a higher paid position, smaller place, I moved companies. I was on the journey. Where do I invest now and what went wrong? And that's when I learned about recession resilience. And so buying for cash flow and stuff like that.
Well, buying for cash flow is the big one, right? Robert Kiyosaki, who does this quick little intro to this podcast, all makes everybody so happy every time I hear. I know, wait till you hear when you get to listen to your episode and Robert Kiyosaki endorses you. But here, he endorses the show that you're on. So he is the genius of the cash flow. He's cash flow quadrant. He's rich dad, poor dad, and the rich don't work for money. Were some of those things part of your origin story or just this great company mentor that kind of changed your mindset?
Hey, everybody, it's Robert Helms, host of the Real Estate Guys radio program. And when you're not listening to our show, make sure you're tuned to Capital Hacking. You're going to dig it.
Well, there was a lot of contributors to it. And the Purple Book was absolutely critical to it. And when I read it, I'll tell you what, it spoke to me. My father has 3 doctorates, one in divinity and one in education and one in evolution. So I had been raised in an academic household, was an educator. My sister's an educator, PhD, clinical psychologist, professor, runs a clinic. Mom ran preschools growing up. But they were so passionate. They're so passionate about what they do. They weren't ever thinking about anything as an investment. It was very stark for me. Reading a book that described my life, reading a book that described like where I'm at, and really not wanting. And there was other entrepreneurs, like my dad's mom's dad, right? We had some oil royalties that came through. My mom collects, not substantial, but they're there, right? And then there was like my mom's dad, my grandfather also had some real estate investments, but there was nothing in my immediate area. Like I didn't have any support. So I was kind of venturing into this unknown space, but it resonated with me and I got it. And I had already lost it all one time and I was determined not to do it again. So, but yeah, that's when I started meeting people, going to meetups, getting physically in front of, going to every warrior boot camp I can find, with those weekend getaway things and those buying programs and learning them, downloading audiobooks every morning. I run every morning and I listen to audiobooks and webinars and stuff still to this day. And eventually I started learning and I told my wife, it was like, this is my 3rd master's degree, but this is my last one, because at this point, like I'm actually learning what you need to be successful.
Yes.
Not just learning how to work harder, but learning how to make a difference with.
I love hearing that. I love hearing that. So with your journey, by the way, we have to fast forward to today, right? Because we want to keep our listeners excited because we're going to deep dive into all the things passive investing mastery does. So now let's fast forward and then we'll go back a minute later. But today, what does today look like for Patrick Grimes and what is the business? Give us a little more insight into passive investing mastery.
Well, passive investing mastery is really 2 things, which I think are super awesome. One is I wish when I was younger that somebody was coming to me saying, hey, here's the 50 different alternatives you can invest in that give true financial security and stability outside of the volatility of the stock market. Instead, they were like, here's 50 stocks and 50 startups and Bitcoins. And so I created an educational platform, which you were on yesterday, where we dug into hospitality. We have one next week on AI data centers. And before that, it was cannabis and timberland and airline pilots and every kind of real estate you can think of. Laundromats. We've covered so much stuff, but it's a platform where I just agnostically, blue ocean approach, educate on every kind of alternative investment that's outside of the stock market. And I think that's the college course that they should be teaching. That's the college course. That's the junior high course. The high school course that should be teaching is what true financial literacy means and your options of the investment landscape. And so we do that. We teach, educate on that. Also tax strategies, and asset protection, and estate planning, and retirement accounts, and all the things you need to know to build efficiently and stabilized and protected generational income and wealth. So that's one of the aspects that I'm just really excited about.
And then what else? What else is there?
So the other side is like, well, I'm one of somebody that rode the high-tech wave, the dot-com boom. I rode Y2K. I rode and meanwhile, I rode the real estate wave. It was in 2009 that I lost it all the first. And then I built I was partner in thousands of apartment units. And what happened in 2002? Interest rates skyrocketed, valuations dropped. That stripped a bunch of the equity from half a decade or more of work. So if I was all in again, just like I was in 2009 in real estate, that would have been really challenging. But I wasn't. Right? I build what I consider to be is my passive investment is really 3 rings of the Venn diagram. One is, does your investments have recession resilience, right? Are the fundamentals stable through market downturns, right? Are your new investments non-correlated to your existing portfolio? And if you're all in the stock market, then you can't do more in the stock market. That includes REITs because that's all paper. But if you're all in real estate, then maybe an allocation into the markets makes sense. But that's an allocation. There's also allocations in others. So non-correlation. And we talk a lot and educate about what's correlated and what are market fundamentals and how it drives those.
And may I interrupt you there first? So when you say you teach on that, is it always through this platform like I did with you last night, panels of experts?
So we have a bunch of webinars that we do. And if you actually look in our history, I've done my own one-on-ones, like what is recession resilience? What is non-correlation? I do one-on-ones as well, or one-to-minis, I guess. And if you look, I do educate. I'm going to be on stage at Best Ever in Salt Lake speaking on Friday. If anybody wants to join us in 2 weeks from now, I think it's on the 19th. I'm February, really excited about that. But I speak and we record all that stuff and we get it out. The day before yesterday, I was on one on private credit. I was on a panel on private credit hosted by Bronson. It was a really cool one. We had 4 fund managers, all in private credit offerings, and we featured our commercial debt, litigation, legal, and medical in there. But so I do a lot of education. I also write a lot. So I write articles in Forbes, and I got blogs out there. So there's a bunch of content. I've been over 100 podcasts. There's a lot of things that I'm doing to educate. But in all of our slide decks for deals, we actually address what is non-correlation, right? What does it mean to invest into markets that have different fundamentals that don't rise and fall together? So if you're looking for recession resilience, you're looking for non-correlation, and then we have a third one. We don't want to have to go too far into it, but it's insulation from AI disruption. And I had to add that. I had to add that wrong because there were industries which I was very excited about, one of which was rolling up CPA firms. What happened? Now you see the big CPA, the top big 5, big 7, I think it is, that they're starting to lay off because it's becoming so much more efficient. Some of those industries are on the chopping block, and you got to be really careful, even in the top next 5 to 10 years, what you aggregate, what you put together based on insulation from AI disruption. So really, that's the focus. And so now I'm spearfishing investments for us to sponsor as Passive Investing Mastery. And those are ones that fit our buy box, that help investors not just have independence in one asset class like I did, and then ride the wave and fear the news every time the one indicator that you're looking for that drives your whole world fluctuates.
Wow. I like that. I like the way you're going about it. And by the way, great domain, Passive Investing Master. I've said it so many times. You can tell I love it. And as a matter of fact, that AI disruption one, or combating AI disruption as a strategy that you want to keep your eye on, and what do you look for? Is that what led you to do a panel that had us as an expert on hospitality? Or what was your origin story on that panel?
Well, so the Passive Investing Mastery, we go through every kind of alternative asset class. So it wasn't specifically AI disruption. And it's not, I don't think you can battle AI. It's happening. I think you want to have an industry that's not going to become functionally obsolescent through AI, right? And that's happening in a lot of industries right now. And it's going to escalate. It's going to be an exponential curve. Hospitality, are people still going to need to travel? Are you still going to need hotels? Are you still going to want to have some place to eat out? There may be some questions there. Why? Because Tesla just announced they're shutting down the factory I used to work in when it was Toyota, and then I worked in again when it was Tesla, and I did the robotic assembly. They're ripping all the car manufacturing out of that, and they're putting in robots that can do your laundry, robots that can do your cooking at home. And my wife, she had a Chinese cooking robot shipped in on her lanai side kitchen here, and we're already automating our dinners here at our household. So like, when you can have a gourmet meal made by a robot at home, will that affect the service industry?
Can I ask you real quick? What did you just say you had shipped in from China? What was it again?
A cooking robot.
You have a cooking robot?
We have a cooking robot in our kitchen.
Okay, time out. I'm not sure I understand what that is. Is it like a humanoid looking thing, or what is it?
No, it's not. So it's actually more functional than like a humanoid, because it sits on your counter, but it has like change out blades where it can like stir fry, it can pressure cook, it can steam, and it's a little touch screen that's you search through the recipes and it'll tell you add a little bit of this. So you add a little bit of that. It does it all by weight. So you can say add a little add much. You never have to use any measuring cups ever again. There's just an incredible amount of, and then it'll go through frying, simmering, stirring, and then pressure cooking, and then do twice cooked pork all in its own. It's insane. The thing's amazing, and it pumps out actual like restaurant tasting food. And that's what I'm saying. Is there a risk that you're gonna not need cleaners of your house anymore? Is there a risk that you're not gonna need to go out to have a great meal? Is there a risk that you may not need to go to the car mechanic? No, not really. You probably need car mechanics. What about AC units? Well, you're still gonna need somebody to repair your AC.
No, I get it. I get it. It makes me think about real quick on the, it's funny about AI, because obviously we know it's innovation and the component that it will disrupt a lot of categories of business. Absolutely. And there's a lot of money going towards it. I heard one time you did a webinar on data centers. So
next week, actually.
Yeah, that's right. You said that's coming up next week. So data centers, great idea. And technology using AI or AI enablement, great idea. We just share a true story over the last few weeks for us here at the Viva May and all the resort platform we built, which, I've been building because it was good to build. It's good to build something that is excellent and treats people with love and dignity and all the good stuff. And of course, because our business is based on contracts and weddings and events is a core component, we've been able to weather all the crazy stuff over the last 7-8 years. And then before that, 10 more years. So that's the way I looked at it, doing the right thing, stabilizing it through contracts. In the last 2 months, we have been in conversations with potential strategic partners, basically platform, private equity, platform partners that are saying, this is the first time I've ever heard this, but it makes sense, that they're seeing us as part of the AI play, being correlated in a way that the more AI grows, the more businesses like ours that are not obsolete because of AI. That doesn't mean one or two of the roles that we have here at the resorts could be automated. Absolutely, it could. But the event of an experience with humans has been around since the dawn of civilization, right?
Yes.
Even eating dinner with a robot is not the same as eating dinner in community. So
That's
even though that robot probably will eliminate the private chef component, it may not eliminate the fact that you want to go in community. So they called us, this group is saying to us that they're putting us on that play with AI. And I'm like, what do you mean? Well, they're like, as more AI goes and more things do become obsolete, we want to be in a safe haven that may actually grow. And then, of course, ours, I was briefly sharing with your community last night, but ours is nature-based and the opposite of tech. Not that we use great tech. That's why we're so efficient. But the thousands of acres are uplifting. And so they're the opposite of like immersive VR, immersive AI, where you start to feel actually anxious, right? Anxiety and depression are on the rise. All that stuff is somehow associated to too much automation and too much detection. So anyway, I was really honored by that. And as a matter of fact, we believe we're currently experiencing two really cool things that you would love. One is a portfolio effect of having multiple properties and more growing. That helps because that attracts a different type of investor that is willing to push your cap rate down. And you did a great job last night studying hospitality because you talked about how the cap rates are higher, which means you can't easily engineer it. You know, back in the day when people were buying multifamily and the cap rates were super small, 4 or 5%, 4.5, you could change a value by $200,000 of EBITDA, $100,000 of EBITDA, and it would have a disproportionate benefit to the appraised value, even though you didn't really make much more cash.
One way or the other.
Yeah, one way or the other. So that's not how we make money. We make money the old-fashioned way. We make money. But anyway, I thought you did a great job last night, and so that's why I wanted to really compliment the community you've built. And also,
Josh, let me just say, when I said AI disruption, I was meaning more like in our world, it's like you're calling takeout, right? You're not necessarily. I 100% agree. If you got that green space, you've got that community building. That's what it's about. It's not necessarily. It may not be about having the best meal anymore because you may that level might be coming home. But if it's about community, I love it. It makes more sense.
Now I want to ask you about an article you wrote for Forbes, which is great platform, great job there. You call it the Ruse of REITs. Just Professor, sit down for a moment, maybe a minute here, and explain to us what is the Ruse of REITs and what are these? I think it would be a great little educational piece of the show.
I think my sister, if she hears this, she's going to fact check that professor because I'm like one of the few not professors in the family. And my 2 master's degrees does not equal a PhD. She's very clear about that.
Professor, I gotcha.
But the problem is that when you get a job, you're working hard, you make money. They want you to put it either in company stock or with the company 401k, and they'll match it. Maybe all that they're going to tell you is graduate it to an IRA because they still keep control over it. And quite honestly, you're that manager's annuity plan. They want you locked up in there forever so that they can retire off of you. And that's not a good place to be. They'll say, oh, we've got you diversified into REITs. Well, what are REITs? Are publicly traded paper. You're not investing in the underlying real estate. So what does that mean? You're not getting the tax advantages, the depreciation. You're not getting the inflation hedging aspects of real estate. You're not getting the secured asset because the company value of the REIT could drop to zero, even if the real estate hasn't, right? So you don't have any recourse action to go in after that asset. The challenge is, and if you look at the charts, and we show this in our decks, if you look at the charts, I actually put from the Fed data, Federal Reserve data, the index of REITs values versus the S&P versus real estate. And it is the REITs and the S&P track in the stock market, they do track very, very closely and with significant volatility, right? So I just try to say the Ruse of REITs because it is like that dying hope of the financial advisor, financial planner trying to clamor as best they can while putting a little bit of a blinder over your eyes saying, here's a lesser thing that doesn't give you the tax advantage, the inflation hedging, or the resilience, but we can say it's real estate.
They call it real estate, right? But you're saying you made a point that I would love for you to dig in a little more. So you buy 100 shares of a fancy REIT for, let's say, office retail shop strip centers, which perhaps are doing okay right now because people still use drive-to strip centers, maybe. And you buy in some. You buy 100 units of that. You're saying that the paper I bought could fluctuate or will fluctuate up and down, even if the underlying real estate, let's say the rents on those spaces are stable and unchanged this year. The paper value could have gone up and down. Is that basically your point? So what makes it go up and down, and why do they call it REITs then?
Hi, this is Melanie McCallan. Josh and I are just so grateful for the many investors who have already joined us at Accountable Equity. Accountable Equity is so much more than a capital group. It's really a community of accredited investors that want to learn and grow together. I just want to personally invite you, if you want to find out more about this type of investment and see if it's right for you and your family, please visit us at accountableequity.com.
Hey, it's Hal Elrod, author of The Miracle Morning, and you're listening to Capital Hacking. Enjoy.
Well, so you're actually buying an interest in the company, and the interest in the company is valued based off what it trades at. What things trade at are the sentiment about how well the economy is doing. On the stock market, people look at, hey, this is how I feel about the future of America, the economy. And so everything on the stock market tends to go up and down based on the allocations they make to the stock market, which is a future bet on where they think our economy is going. However, the safe haven assets, the assets that people tend to invest in, that are outside of the stock market are actually hard assets. They tend to go into gold and oil and gas and real estate. Or in our case, we love legal and we love medical because those are even more resilient than the aforementioned ones. But the issue is they're going to pull that money out of the stock market, real estate. And I'm not trying to make anything up. If you go look at yourself, you can plot the data of REITs in the stock market. It trends with itself where real estate stays completely non-correlated. It doesn't mean real estate doesn't go up or down. It means that real estate shows low correlation. It means that it relies on different market fundamentals where you don't have that sentiment driven of the volatility of the stock market affecting your direct real estate holdings. Meanwhile, your returns are amplified because of the tax efficiency and the inflation hedging and your cash flow, right? So you get that cash flow appreciation.
Let's dig in on that because you're teaching a lot of great ideas here that I want to make sure everybody follows you and stays up with you. But we'll come back to that about the direct type of investing in real estate versus what is called a REIT. But before we do, what is the difference between a public REIT and a private REIT? And do they have better fundamentals if it's a private REIT versus a public REIT?
Typically, when it comes to, REITs, most people are thinking about the public REITs, the publicly traded REITs. If you can access the private REITs and you can't label private REITs altogether because there are private REITs that are specifically designed to be, non-correlated. They're specific asset driven. Now you're not going to get the inflation hedging. You're not going to get the tax efficiency. Right. You're not going to get that cash flow and appreciation. And you're not going to be able to 1031 exchange tax free until you die and then pass no tax burden on. But all that said, those are fundamentally two different things. And you can do a little bit better, right, in the public REIT space.
Well, is it appraised? Is it based on appraised value on a private REIT, whereas in public, it's based on sentiment of paper?
Well, so I'm not a financial advisor, and I'm not I'm not allowed to give investment advice or interpret, and I don't want to talk broadly about these markets because I'm an engineer that's doing a bunch of alternatives, right? And so I'm a little bit hesitant to go too far because I'm immediately going to get hit up by these individuals putting these public, and private REITs together. And they're going to say, oh, that's not true for this specific case and that specific case. And we do these differently. And we're a hedge fund REIT and we've figured out the way to do non-correlated private REIT. And we're going to do non-correlated returns and we're beating the, and this and that. And that's the case. That's true. But you can only really answer these questions in kind of like a broad, sense.
That's a good point.
Ruse of REITs from your financial planner is really at the heart of it. And
I love it.
They're traditionally the large publicly traded REITs. But I don't want to get on like a situation where I'm like pissing off my Forbes buddies, right? Because there's a lot of these other guys that are in there.
Let me take you off the hook then, because I thought that was already fun. So let's get into the cool things and the community you've built with passive investing. And, you actually do sponsor funds now, and you sponsor your own projects and funds, I should say. And you have said to me that you've learned the power of partnership. Would you mind sharing what you meant by that and how your business works on the fund side?
Yeah. The first time I tried to do it all myself and lost it all. And then the next time, I tried to follow the guru, and I lost my life. I took over everything. And then when I finally figured out how to work with others, partner with others, I was able to build a sustainable portfolio where I could do what I'm really good at. Somebody else could do what they've been doing for decades and in markets that are better markets and in different asset classes that are non-correlated. So partnering was really what allowed me to build the quality of life and the security in the portfolio. You just simply can't build enough investments, a portfolio with enough investments that rely on different market fundamentals to have stability doing it all yourself. You can do that maybe you can be good at a lawyer, an engineer, a doctor.
Yes.
But then you can't do it again in real estate. But if you do and you're successful, you're like the 10% to do, you've lost a lot, you've traded a lot of your life away. But you actually need 7 of those or 10 of those, depending on who you talk to build stability. You don't have 7 lifetimes. And I don't want to live like Elon Musk either, right? I don't want to live where I've traded my life away for my investment for that. I want to augment it. And so partnering, I've been in enough partnerships and deals to know I should have been in less partnerships and less deals. I think part of it is patience and learning to be very hyper-focused. And for us, it takes me years to find the right people. And I spearfished different industries. And then within those industries, you got to figure out how to solve a need. You got to figure out what asset class provides enough security and resilience and what structures within those. And so we've curated a set of investments that all fit our very specific buy box, non-correlation, resilience, and insulation from AI disruption by finding people that have a decade and a half in every case in commercial debt, litigation funding, and medical receivables have shown huge, tremendous ongoing success. And we've set up businesses together, like shake hands with these guys and we become partners and we originate all our own investments. And I'm an engineer, so I'm big on the numbers. And then we aggregate capital and build hyper-diversified portfolios within each of these different sectors, right? And that's what's been really strong for us.
No, I think it's a beautiful model. Let me ask a couple fun questions about it. Since you talk to a lot of wonderful investors, I imagine you're like our team at Accountable Equity, where they have accredited investors, and this means people that have the SEC guidelines of over $1 million of personal net worth, not counting their house. So when you're talking to those families, it's best to start with education of categories. And I think you did the best thing possible by creating your webinar series. Great job on that. So you've talked to a lot of investors. Here's what we learned are the key interesting questions. One is IRR. A lot of times investors will ask you, if I invest in that portfolio fund that you have, Patrick, what would be my IRR? Now, instead of overly explaining what an internal rate of return is, can you just share what percentage points, 10, 15, 20, is what they are pursuing, and what they think of higher numbers versus lower numbers? What have you learned about people's appetite when they see big numbers versus middle numbers versus little numbers in IRR?
Hey guys, it's John Vroman, founder of Front Row Dads, and you're listening to Capital Hacking, the best investment you'll make today.
I'm probably going to answer it in a couple different ways, because in private credit, you can be current oftentimes with your cash flows.
So no IRR, right.
Or you can look at IRR. So let me answer it a couple different ways. For example, in our debt fund, where we're lending to small balance commercial real estate, and right now we're getting high interest rates, not 6, 7, 8%. We're getting 10, 11, 12. What does that mean? That means, well, we have a lot of churn, right? Because we're doing bridge loans, so we're able to have investors in and then pay them out, and we're clipping significant rates. There are two different kinds of investors. There are some people that love that growth. That's something they're working, they're making a lot of income, or they're investing from a retirement account, and they don't want cash flow because it just sits there. They'd like to reinvest. So there's the growth, and then there's the income. And what we found is that there's investors that are one versus the other, or there are those that want to switch between. So if you give somebody the ability to switch between growth and income, you can provide rates between sort of that 7, 8.5, 10 to up to 13 and 14. And they'll go between sort of that income, shorter lockup periods where we have 90 days, 6 months, or 1 year at 7, 8.5, and 10, which means they can get it out, right, pretty quick, and they can do income. Or if they're really looking for longer lockup periods, even since inception, we were hoping for like 11, 12%. We've been doing more like 13, 14.25% for the longer lockup periods. And so what we've found is that there's literally like a 4 to 5 point spread for those individuals that prefer shorter lockup periods, and they're willing to forego the 4 to 5 points than for those that have the longer lockup periods, right? But what we found is that those individuals that are saying, hey, you know what, I'm okay not doing the liquidity, I'm okay with the longer lockup as long as I can kind of toggle between cash flow and not cash flow, right? And so a lot more people would be like, okay, as long as I can grow it now and then tell which day I can cash flow. So we found kind of like this different makeup, and based on where people are at in their lives, you can put them in different aspects.
You know what's interesting? You've said what we have found too. So, Scott Bindis runs, and Bob Bolin and Phil Boja and Ketan Bhavan. These guys are actually the managing directors and leaders of our Accountable Equity, and they have said the same exact thing. And that's the fact is, you even said, when you offer total aggregate returns, people sometimes trade off liquidity or cash flow versus growth. And in the growth category, I thought you said exactly what our research says, 14% would be like very successful growth program, and 7% would be incredibly strong cash flow program. So we agree with your range 100%. We find that. As a matter of fact, I get approached sometimes by different types of investors, and they'll say, how come your IRRs aren't 20%? And I say, one, we build a very conservative pro forma, and 15% is about the most I ever believe our pro formas can get to. Though we're going to try to hit home runs every time, we are very comfortable in this range between 13 to 15% on a growth and lower for cash flow steady, right? And it's funny how almost every investor agrees with that understanding. Not many actually believe the 20+% IRR, because it is, I want to ask you, why do you think most investors don't believe it, or do you disagree with me?
I think it's an industry-specific number, first of all. When you said most investors, because I can't believe how many times I can think of a dozen right now where somebody, well, your returns are just not interesting to me. I'm only looking at 30%, or whatever. Right. And I'm like, I can get 30% over here. And I'm like, dude, that is an unsecured consumer line of credit fund. Like, that is a very different fund. It doesn't have the recession. It's not in a secure position. There's no lien. There's no ability to take collateral. But there's different industries, right? And some industries become much more efficient, where like you're in real estate, there's a lot of operators, a lot of players, right? So the numbers you're saying are, which I originally started out, private credit, first position debt, commercial real estate. There's a lot of, there's ability to provide the returns, like you said, in the ranges like we're talking about. And that is very palatable. I think to answer your question about what's believable, I think that some of the lesser known non-correlated alternatives provide greater returns at a lower risk premium even than real estate. Why? Legal and medical, they just never go down. And for every 1,000 real estate operators, there's one medical financing company. For every 1,000 real estate operators, there's one legal financing company. It's a boutique industry that if you've been in it for a decade and a half and built a reputation, those are who they go to, because it's a smaller industry, right? So you can get, and private equity and hedge funds and sovereign, they all know this. You can get higher returns in less efficient markets with less players if you have a relationship, long-standing relationship. So do I think that the numbers that we're both talking about make a ton of sense in real estate? Yeah. Absolutely. But is it very normal to bag 20, 30% returns in legal funding? Very, very common. If in fact, there's publicly traded stocks that doing that in legal funding. I mean, that is not a question, right? And of course, every investment has the sliding scale of high risk and high return versus, very late stage, no risk and established. But then in medical, typically it's around that 10, 13, 14, 15% current payout, right? So that is higher, I think, than where you don't have to go down to the 7. You're and you can do 1-year lockups for 10, you can do 1-year lockups for 15, and be in existing receivables that you can underwrite, that have liens, that have care that's provided with government or institutional payers. It's about as secure as a payment can get. And you can actually return 15% current cash on that asset.
No, that's good. And that is new to many people. So that's why you do those educational webinars. And that's why I compliment you and look forward to finding ways to do more with you. And I just think this has been fantastic. And I think, Patrick, would you mind sharing with our team of our wonderful audience how they could find out more about you?
Yeah. So, and Josh, you've been fantastic. Like I said, you did an incredible job yesterday and today. Thanks so much for having me. Patrick Grimes at Passive Investing Mastery, all spelled out. Passive Investing and Mastery, all spelled out. At the top, we do have some of our investments. Down below the page, we have the opt-in for our Alternative Investing Mastery series. We're going to do AI data centers. I mean, we're going to do every single different kind of alternative asset class. If we miss one, tell me about it, because we create these based on a lot of the times feedback from you, and we're all live. John knows, we wait till we get all the questions answered, and there's a bunch of questions. There's like 40, 60 questions. So get in there, dig in there. And when you start learning these new asset classes, start to be more familiar, more comfortable, feel more confidence in finding the ones that are the right fit for you. And set up a meeting if you'd like. I actually give away this book. Josh was giving me a hard time about it because he knows the guys that I did this with here. This was Lessons from Thought Leaders. I loved it. I think Russell Gray's on here, Navy SEAL, Phil Consley, guitarist of Def Leppard, Kevin Eastman, Tom Ziegler, Dennis Waitley, Brian Tracy, a bunch of really cool people.
Really great people.
It was really fun working on this book, and I give it away for free. Gosh, passiveinvestingmastery.com/book is this secret link. And as long as you put Josh McCallan, the promo code, if you don't put anything, we're not going to ship it to you. But you can either download the PDF or you can put in your address and we'll sign and ship you a copy. And if it helps, I tell my whole story. these guys all tell theirs.
I
And
love
if
it.
it helps your journey, learning about my ebbs and flows and losing it all and coming back and journey into alternatives, moving to Hawaii, moving to Honolulu, talk about all of it. If that helps it along your way, then that's enough for us. And make sure you set up a meeting too. I'd love to chat with you. I mean, wherever you're at, if any of this is resonating with you and you're like, you know what, I kind of would like to put a slice of my pie into something new that won't rise and fall, not correlated. That maybe makes sense. Set up a call. We have opportunities, but we also have a Rolodex of 50 other alternatives with people not as awesome as Josh, but really great people out there and all kinds of different alternatives. We can get you pointed in the right direction.
Well, that's very nice of you, Patrick. Thank you, buddy. We'll have you back on soon. Ciao.
Thanks, Josh.
Damn straight. We just got we got to the end of another great show. And everyone listening right now, you're the family and friends. Thanks for staying till the end.
That was so fun. And hey, hit the like, hit subscribe. We're here to serve you guys. That's why we're doing this show. Josh is not paying me. I'm doing this off of my quote unquote sweat equity because we want to make a difference in your life. And then that ripple effect will continue to touch the world.
Hey, amen, brother. Please check us out on capitalhacking.com, all the social media threads. And yes, I know you've probably already sent this episode to one of your best friends. Thank you. We love you. Just go right into your iPhone, hit the plus symbol. We'll talk to you later. See you next week.
Share.